Hello everybody. So in today's video I wanted to react on Bill Miller's statement about Tesla and kind of lay out why I disagree and rebut each of his arguments in my own way. So please allow me to play the short 30-second clip of Bill Miller criticizing Tesla, and then I'll try to take his comments one by one and outline my argument and my viewpoint. So let me play the video, the short video.
Bad.
Not for the past year, but more recently, and I actually shorted more today.
Okay.
So
You shorted more Tesla today.
Today, yeah. I mean, I think Tesla's been a phenomenal company. I think Elon Musk is a genius. But you know, a $380 billion market cap against the General Motors at 50, more than probably the top 5 automakers combined. Tesla's now losing market share. They're cutting price. BYD is introducing a luxury version over in China. And it's a phenomenal company, but it's not worth $380 billion in my opinion.
So Bill Miller's criticizing Tesla mostly because of valuation, which is surprising because Bill Miller is an investor in Amazon. Actually, his personal portfolio is half Bitcoin, half Amazon, as is famously outlined in the past. And so he's successfully identified Amazon, which is interesting that Bill Miller is criticizing Tesla for being overvalued, while Amazon has been considered overvalued by classic value investors for the longest time. But I've outlined 3 points that Bill Miller has against Tesla and as to why he is shorting Tesla. And so I don't know the time horizon that he has for shorting Tesla, but I do believe that I have some arguments against what he's saying, and I hope to outline them in this video. So let me begin. The first argument that Bill Miller is making is that Tesla is losing market share. And yes, Tesla is losing market share, but it depends how you look at market share. And for that, I think the best analogy is Apple. Apple also lost market share after it introduced the first smartphone. When you are the first product introduced, you're going to lose market share as competition comes, because you as long as there's one other type of product sold in the same category, you lose your market share. That's just the nature of the game. So Tesla is losing market share of the electric vehicle market, but it's a category that it essentially created. Right, GM had killed an electric car, as a famous documentary showed, that they tried to launch and they just killed it. Like, Tesla essentially forced the entire market to go into electric, just like Apple forced the entire market to develop smartphones. So of course you're going to lose some market share of the product that you created. When you start with 100%, and they started with 100%, the only way to go is down as new products are introduced. And so that's okay. And I'm not denying that Tesla is losing a little bit of market share because the competition is a little bit there. So, and I think the most compelling case one can make for that is BYD. Build your dreams, right? The Chinese company is a tough competitor. In China right now, a lot of Chinese people are very patriotic. They want to buy a Chinese car, and China is going for an economic crisis. So they want inexpensive vehicles right now. But Tesla just addressed that a few days ago by lowering prices by about 10% across the board. They've made improvement to the factories. The costs are going down heavily to the factories, and thus they've been able to drop prices and now be very competitive with BYD. So I would expect the market share of Tesla to go back up in China. But BYD is a competitor, there's no doubt about it. How about the European market, right? Well, Tesla is losing a little bit of market share there as well, but they've been working on a gigafactory that has been slowed down by a lot of red tape, but now the factory is gaining speed, and so they're going to have more products, more of their cars introduced in Europe, and that's going to help their market share go up. Also very important for the European market. Tesla is an American company. They've made vehicles that are best suited for the American market. Europe is a lot of very, very small vehicles. That's what dominates in Europe. Very, very, very small Volkswagen, small Renault car. This is what dominates. And so they don't have the Model 2 yet, but Tesla will have the Model 2 at some point. Once the other cars are fully ramped up. And the best way to judge Tesla is to judge it within the US market. Just like the iPhone was best judged in the US, and the iPhone is 50% market share in the US, it's fair to look at how Tesla is doing in its home market. And frankly, the slowdown in the market share of Tesla in its own market, in the most competitive market, has been very small. This is from Troy Tesla, most likely the best analyst on Tesla delivery numbers out there. And as you can see, we've been between 60 and 80% pretty consistently for the past 2 years. Yes, the trend is a little bit down, but it's nothing alarming, it's nothing concerning, especially when you take into account the fact that they've raised their prices so much. Tesla has raised its prices so much. And so I have no doubt that this market share, even though it may go down a little bit, it will remain significant. My baseline for this is about 50% over the long runs, right? So it has a little more to drop, but no less. This is the company that was designed for America. American these cars are made for America. So nothing concerning to me. Also, Tesla only has 4 vehicles, but really it only has 2 meaningful vehicles, the Model Y and Model 3. And there's a category in the US that is really, really strong, which is the truck category, right? The pickup truck category. They don't have that. They're hurting because they don't have a pickup truck. They're going to have a pickup truck in 2023. So I would assume that the market share slowdown not only is very small right now in the US, but it's going to grow back up as soon as they start delivering those pre-ordered Cybertruck. The pickup truck is a huge segment in the US. So again, nothing alarming when I see these numbers. I don't think losing market share is bad at this stage of the game for Tesla. Furthermore, and this is important to say, it depends how you define market share. Like, yes, Tesla is losing market share, but that's only when you look at the electric-only market share. What's the relevant market? Is the relevant market for the iPhone, is it the smartphone? Was it the smartphone when smartphones were few and far between? Or was it all of the phones? Well, the same is for Tesla. What's the relevant market? It's all of the cars. It's not just the electric cars. It's all of the cars. The electric car is killing the gas cars, just like the smartphone killed cell phones and all of our types of phones, right? Nobody has a home phone anymore. So it's all about how you define the market, and you should define the market at least as automobiles, at least passenger vehicles, at least, and more broadly, you should define it as transportation as a whole, because Tesla is also about to disrupt the truck market. So and the taxi market. So there's lots of things that you can disrupt with Tesla. And if you look at market share, by defining it as vehicles in general, not even transportation, vehicles in general, electric cars are only 4%, right? They will be 99% one day. They're very, 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 very small, a very small share of the market. They're actually about 6% of the US. Tesla is only 4%. So Tesla only has a 4% market share, but you can see that the market share in total passenger vehicles sold in the US for Tesla is only going up. They're taking more and more and more share, and they're taking more and more share actually in every single market as we move from 6 to 7% of all cars sold electric to eventually 99% of all cars sold being electric. Because the electric car is a much, much, much better product, just like the smartphone is a much better product than, say, a flip phone or a smartphone. Nobody has those anymore. In 10 years, nobody will have gas cars anymore. Electric cars will be the norm. They're cheaper, they're better, they're faster, they're safer, they have so many advantages, which makes it so that the share of electric cars sold is just going to be tremendous, just going to be huge, and they are winning that. So the market share, Tesla is losing market share if you look at just electric, but it's gaining market share if you look at all of the cars sold in the US, which is, I think, the relevant variable to look at. Argument number 2 of Bill Miller. BYD is introducing a luxury version. And I fail to understand this argument. I don't understand this argument. The bulk of Tesla sales are not luxury cars. Tesla used to be like 2 or 3 years ago. If you don't update your models and you still think of Tesla 2 or 3 years ago, you could have said Tesla is a luxury company because they only had the Model S and Model X, at least ramped up. Now, Tesla is not a luxury company. So it makes no sense to say that Tesla is going to lose some market share because BYD is introducing a luxury version in China. Tesla is not a luxury brand. If you look at the numbers, under 5% of Tesla's sales are for Model S and Model X, which are the luxury models of Tesla. Tesla does 95% of its sales in the non-luxury Model Y and Model 3. So Tesla is not a luxury brand, and I do not understand why that should be even a threat that someone is introducing a luxury car. So I think there may be a problem of updating the data here. Tesla's focus is not on luxury. It's on building the best cost product or the best mass vehicle, the best mass product for most of the world. A good corollary would be the Toyota Corolla, the highest grossing car in the world. It's the most sold car because the most consensus car. Tesla is trying to create that unique car that will best suit the needs of everyone. This is the same as the iPhone. The iPhone best suits the needs of the most people. That's what Tesla is focused on. They're not focused on luxury models. So I do not understand where this comes from and where this thinking on models comes from. But it's a common type of thinking in the legacy financial world, I would argue, because that's one of the reasons, for example, why Tesla hasn't had higher credit ratings, is because you don't have enough models. So they're not getting investment credit ratings from a few agencies because they're getting criticized for only having 3 models. But if Tesla is trying to cover as many people with as few models as possible. And you can see GM has a very different strategy when they say they want to have 30 different models. It's a very legacy way of thinking. Which brings me on to the third argument, and only argument in this 30 seconds clip from Bill Miller, which is the idea that Tesla is not worth more than GM. And you actually said Tesla is not worth more than the top 5 automakers combined. Actually, when I calculate, it's not exactly this case anymore. At a $380 billion market cap, it's not like that anymore. I mean, they're not worth $1 trillion anymore because the stock has dropped so much. But just for the sake of argument, I'm just going to compare Tesla to GM because Bill Miller talked about GM a few times. So first of all, important noting, Tesla and Ford have never gone bankrupt. There are only 2 car companies that have never gone bankrupt. GM went bankrupt. They went bankrupt once, and they can go bankrupt again. So that's first of all one of the big takeaways. The car industry is a very, very, very tough business, and perhaps GM is valued so low because it is a risky business. So let me just move on through a few numbers. These are revenues over the past 12 years for GM and Tesla. As you can see, GM over the past 12 years, their revenues has been very, very, very spotty. I don't know, it's been between 100 and 150 billion in revenue. That's it, and it's been flat. It's been essentially flat. So GM is not a growth company. It's a stagnant company. It's not a growth company. Quarter to quarter, there's lots of fluctuations. Tesla growth has only gone one way, and it's up. And they are going up, and they're at the beginning of their exponential curve. We said only 4% market share in the US. That's the only 4% market share. Tesla can go so much bigger. There's a lot of countries that Tesla is not selling into yet. There's a lot of products that have not introduced every year. There's so many growth levers that Tesla is just starting to pull. While GM has a very, very widespread legacy dealer network, legacy brand, there's few areas for GM to expand other than creating new vehicles and trying to sell new vehicles, electric vehicles, through its legacy system. Tesla's growth has been exponential, and it's just the beginning, I would argue. It is just the beginning. And stock prices are supposed to represent present value of future cash flows. I don't know what the present value of future cash flows of GM is, but I would argue $50 billion is a lot of money for the present value of future cash flows for GM. And I'll just talk briefly about why. This is why. GM is highly indebted. Keep in mind, I'm only talking about long-term debt, and you'll see liabilities are much bigger than long-term debt. I'm going to go into the liabilities a little bit. GM has $77 billion in long-term debt, while Tesla has $2 billion. Tesla has been paying off its long-term debt because Elon Musk wants the company to be anti-fragile. He's gone too close to bankruptcy too many times, and then he wants the company to have close to no debt. GM went bankrupt, and it doesn't seem to me like they're learning. The auto sector, at least the legacy auto sector, is a cyclical one. And once electric cars are 100% of the market, I have no doubt that electric cars will also be cyclical. Right now, Tesla is escaping that cyclicality because they are replacing the legacy product. They have a very, very successful product. But the debt is very high, very concerning for GM. Okay, let me move on. GM not only has a lot of debt, long-term debt, but they need to invest heavily for the new electric vehicle transformation. So they are building plants in Ohio and Tennessee, and they're updating a bunch of plants, and they have to invest $35 billion for 2025. There's only 2 years left, right? Tesla will do just fine with the factories that it's ramping up now, like Austin and Berlin. Tesla already has built its factories. These are what they call, gigafactories. They can manufacture so many more cars in one factory than the legacy system can. So Tesla can probably do just fine for a year or two with the current factories that it has. Although I have no doubt they will most likely expand and create create other gigafactories. They will most likely expand, but they have yet to ramp. They have yet to fully ramp. GM has yet to invest. So when you invest, it takes time. It takes time to build, and that's a lot of money. That it's gonna have a very hard time financing that when you already have so much debt. Interest rate is going to be fairly high. This is not a favorable environment to have debt. Interest rates are up right now. So, moving on. GM carries an important combination. This is in addition to the long-term debt. Carries an important combination of assets and liabilities on its balance sheet related to GM Financial, which is a similar story of what happened to GE in the past. And this is what I'm very concerned. GM Financial is what, right? You go through a dealership, and you finance a car with GM Financial, and so they give you your truck. I don't know, it's $100,000 truck, and then you get a loan, and then you get a car payment, and that loan that GM has given you is both an asset on their balance sheet and a liability, and as long as you pay it off, it's all fine. But what if people stop paying them off? Then you could have tremendous losses. And I think this is what could happen. Many losses could be realized if people walk away from their cars. If people walk away from their cars, all of a sudden, the value of these assets is going to be impaired. And GM is going to have to write down a loss. All of a sudden, that liability and that asset on the balance sheet corresponding to that liability is going to turn into a financial loss. But you're still going to keep the liability on your balance sheet. So you financed revenue. You enabled customers to buy your car with your own debt. And if your customers don't pay off their car, then that debt is carried on your balance sheet. And there's if you go to the balance sheet, there's about $70 billion of delivered cars with associated debt that are placed on GM balance sheet that have yet to be paid by their customers. We are entering into a recession. What are people more likely to stop paying? Are they more likely to stop paying a truck on which they're upside down because people don't want to pay a $100 gas tank? They'd rather buy an electric truck where the tank is like 12 or 15 bucks instead of 100. I believe that gas cars are going to lose their value really, 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 really fast as electric adoption is much, much, much faster than most anticipated. So who's going to want a gas car, say a gas truck 3 years from now, when gas is still at, close to 100 a barrel? Who's going to want a gas truck? No, people are going to want electric trucks because it's going to become obvious at this point that the performance is much better on an electric truck and the cost is much cheaper. So I would argue people are going to walk away from their cars. And a lot of companies do this mistake where they can go bankrupt because they rely too much on financing their own revenue. And this is a risk that Tesla does not have, because Tesla does, and go to the balance sheet of Tesla, Tesla does not own a financing division. Financing is done through third parties. Tesla partners with third parties for its financing. And even if it did, it wouldn't be as much of a problem because electric cars are not going to lose as much of their value as gas cars. I believe gas cars are going to lose a tremendous amount of value. So moving on, let me move on. Tesla is not more than GM, says Bill Miller. Well, they actually have much higher net margins. Gross profit is through the roof higher than for GM, but they have higher net margins. So the average net margin for GM is 5.8%. And keep in mind, that's including highly, highly, highly profitable trucks. Trucks is where a lot of the margin is at for automakers. So GM has a very, very, very high, not very high, but it has a high net margin because of the mix of what it sells and because of its truck. And Tesla has no truck yet. The truck is going to be very, very profitable. The Cybertruck is going to be a model of profitability. And yet Tesla is almost three times the margin with a mix of vehicles that I would argue is typically less profitable for the auto industry. So Tesla is almost at 15% net margin. Very important to also note, the Tesla margin, the net margin on Tesla vehicles is trending up. They're making more and more money as the company gets more and more efficient, as the company gets better at manufacturing, as the gigafactories scale up. Tesla is making more money and even able to drop prices. And so we'll see, because we're entering a recession in 2023. And of course, there's been a price drop in China. There may be a price drop in other places. But then again, on the other hand, you have the stimulus and the 7,500. So we'll see where margin heads. But Tesla, nonetheless, right now in the current market, has about 3 times the margin of GM, and the gap is widening. And I strongly believe that the margin for GM is going to go down because they're going to have to go through the learning pains of building an electric car. They're going to have to ramp, right? It's very hard to be profitable making an electric car. Okay, moving on. Why is Tesla more than GM? Well, Tesla is much, 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 much more than a car company. And the market is giving absolutely no credit to Tesla for all of its other endeavors. It's giving no credit whatsoever. Not that it would need to, because I believe just the auto business is enough to warrant the valuation difference between GM and Tesla. But think about all the other businesses. The supercharger network. Could it be as big as Exxon? Could it be as big as the future Exxon if you have superchargers all around the world from Tesla? Well, I believe it could, 10, 15 years from now, I believe this could be huge. This could be tremendous. You could have a whole network of superchargers, network with associated convenience stores, associated energy supply. So this could be huge. And they are the leader in the supercharger network. And this has an advantage in that it has network effects too, which means that you have a built-in moat. So that could be a separate company one day if antitrust gets after Tesla, because Tesla gets too big, right? That's one. Then Tesla Energy and Virtual Grid, right? Could Tesla be part of a future utility world and the utility system? Could people turn to Tesla to power their cities? Well, that's already happening with the megapacks, right? So this is a big, big part of Tesla. Tesla full self-driving, FSD. Sure, today the market is a bear market. Nobody likes innovation. But, there's a bunch of YouTube channels you can watch. And you can watch the FSD, and I believe it's insanely impressive. And should it have a zero valuation right now? Because that's what the stock price shows, with zero valuation for FSD. Obviously not. FSD gets better as more cars are sold. As more cars are sold, Tesla gets more data and trains the AI software much better. So FSD could be a tremendous part of the business of Tesla. And it's going to be a tremendous lever for margins because once FSD is fully solved, Who's not going to pay 250 or $200 a month to not have to drive their cars anymore? I think a lot of people are going to find it very compelling to just have a subscription to get FSD on their car. So then you turn the hardware into a software business. Absolutely amazing. Tesla Semi. This is a huge business. This is a huge business that is typically not addressed by the traditional auto companies. But the Tesla Semi could be a competitor to some of the biggest truck builders out there, like Peterbilt or Kenworth. That's a business that needs to be valued properly, right? Another one, Tesla Insurance, because Tesla has all of the data on its vehicles, and because the vehicles are much safer. Tesla can charge less and can build an insurance business around Tesla. So could it be as big as a Progressive or a Geico? 10 years down the road, if you think very long term? Maybe. Tesla Robotaxi. Could Tesla become the Uber of the future? Could Tesla disrupt not only Uber, but other areas such as, parking lots at airports or things like that? The Tesla drives you to the airport and then drives back home without anybody. This is maybe 10 years from now, but think about all of the innovations we have today that we could have never foreseen 10 years ago. Think about innovations in AI like ChatGPT or image generation. Who could have even pictured that 3 years ago? So AI is moving really, really fast, and other companies in the auto world have abandoned, they've entirely divested and abandoned that field. Tesla has a huge blue ocean and open runway in that sector if they solve it. So Tesla, the car company, the car business is just one of many, many, many businesses. What are some of the final points as to why Tesla is indeed worth more than GM? Tesla is vertically integrated. They own everything from maintenance to sales to manufacturing much of their parts, much of their batteries. They're going to get into mining probably. They are fully vertically integrated, just like Apple. The margin flows back to Tesla. Tesla is like the black hole of the auto sector of the future. That is what Tesla is. They don't have first, second, third, and fourth level suppliers, right? Tesla has a few suppliers, but they strive to be vertically integrated. They're highly, highly agile. They change their software based on supply chain issues. So much going on in how the firm is organized. Very, very highly productive, efficient firm. Then, Tesla has flexible pricing and manufacturing. The companies are very, very flexible. There's no technical debt. There's no legacy debt, right? If you look at GM, for example, they have about $16 billion of pension debt. They don't have any debt to unions, right? Tesla has very, very low structural inertia in that it can pivot and change very, very, very fast. GM does not have any meaningful electric car sales yet, even though it's been a couple years since they've gotten into that business. Why? Because they have structural inertia. They can't move as fast. And then lastly, which is, I think, one of the underemphasized points that a lot of the Tesla community doesn't talk about, is the fact that Tesla has secured a lot of battery capacity. Tesla is the number one customers of so many battery suppliers. And you can bet that Tesla's business will be the first to be satisfied. And Tesla has secured capacity, right? And they may even get into the mining business. Is GM too late on battery capacity? Can GM secure enough capacity to manufacture all of the cars that it wants to build? And I think a lot of the competition to Tesla is going to have issues because whereas Tesla has secured the capacity, the raw materials for its batteries, that was the limiting factor for the longest time. That was Elon's obsession to secure battery capacity. What are others going to do? Are they going to have the capacity to build all of the cars that they want to build? That is a question out there for people to answer. So these are just some of the reasons on the top of my mind as to why I believe Tesla should be worth way more than GM and way more than the top 5 automakers combined. Way more. We don't talk about Nokia anymore. We don't talk about BlackBerry anymore. We don't talk about HTC anymore. All of these companies, Alcatel, all of these companies are gone. They've been eaten up by Apple. And then you have Android and a bunch of smaller players like Samsung in the cell phone business that make all of these phones. And in volume, I don't deny, for example, that Android has higher volume, much higher volume than an iPhone. But that's not where the profits flow. The profits flow to the iPhone. Most of the profits flow to the iPhone. And I think it will be the same for a car business. Most of the profits will flow to Tesla because this company has, I believe, a very, very bright future. And so you can see that in my Tesla series, and I hope to cover more Tesla. These are just my 2 cents as to why I disagree with Bill Miller. But you know, I admire him otherwise. I think he was a great investor in so many other areas. Thank you so much for watching. This is not investment advice. Never been, never will be. This is just entertainment. Please subscribe and like my video if you can. Really appreciate it. And follow me on Twitter as well if you can. Thank you very much and have a great weekend. Thank you.